Hi, and welcome back to the Food Fund, where we analyze investing in food, beverage, and restaurant stocks. In this video, we will be evaluating the portfolio performance for February 2025. We had a lot of big market moves this month, so be sure to watch through the end of the video to find out what we did. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get started. Cue the logo. Let's start off with the market's performance. For the month of February, the S&P 500 fell about 0.7%. Again, we hit new all-time highs, but the market fell rapidly as we progressed deeper into the month. February also has several key earnings reports. Chipotle reported their Q4 2024 earnings, the first full quarter under new CEO Scott Boatwright. Chipotle generated $2.85 billion in revenue versus estimates of the same, with earnings per share of 25 cents versus estimates of the same. Given all of the challenges the burrito restaurant has faced recently, I'd say that this is a job well done. Average check growth was 1.4% while traffic grew 4%. Boatwright shared his thoughts on the quarter in an interview on CNBC.
Yeah, thanks, Jim. The year we put together, what is a 7.4% comp driven heavily by transaction growth of about 5.3%. What this team accomplished this past year is nothing short of remarkable. A lot of credit goes out to the 130,000 team members out in our restaurants. They're really the backbone of this great organization. And this leadership team really diving into the strategies that were critical to the success for the outcome of the year. The quarter shaped up nicely at 5.4%. Feeling good about our performance there, again, heavily driven by transaction growth, and feel really good about the plans we have set for 2025.
As a shareholder, I like that Boatwright is essentially continuing the trend started under Brian Niccol. Next, Dutch Bros reported their Q4 2024 earnings. Dutch Bros generated $343 million in revenue and earnings per share of 7 cents. The market loved this, and shares gained 25% on the news. Last, Celsius reported their Q4 2024 earnings. Celsius generated $332 million in revenue, down from $347 million a year ago, and earnings per share of 11 cents, down from 17 cents a year ago. However, the biggest news was that Celsius agreed to acquire competitor Alani Nu. CEO John Fieldly shares more in an interview on CNBC.
It's amazing. These two brands together will make us have the largest sugar-free portfolio in the energy category, and it's the driving force behind functional beverages and the energy category. Puts us as a solid number three at a 16 share.
And sugar-free is...
The share price popped over 30% following the news, but has since returned to pre-earnings levels. While it may take a couple of quarters to realize these benefits, as a shareholder, I like the move. Okay, let's move on to the portfolio performance. I deposited $100 into the account on February 1st, 2025, and at the end of the month, the portfolio balance was $759.50. This means the portfolio lost $7.78 for the month, representing a 1% loss for February. The good news is that we lost less than last month and have closed our gap trailing the S&P 500. Given the S&P 500's negative 0.7% return, we lost 0.3 percentage points of alpha by not being invested in the S&P 500. Here on the chart, we can see a barely perceptible change in the portfolio's performance versus the S&P 500. 2025 started with a wide gap, but we are moving closer to reverse that trend. Still, we are clearly underperforming the S&P 500. Since inception, the portfolio has had a negative 5.7% return on a money-weighted basis, while the return on a time-weighted basis was negative 5.1%. Given the S&P 500 8.8% return, we lost 14.5% of alpha by not being invested in the S&P 500 since inception. Not to brag, but this value is improved from last month when we were losing 15.4% of alpha. Tiny steps towards victory. Now let's look at the portfolio moves for the month. First, I bought some Celsius on February 3rd, Pepsi on February 4th, Chipotle on February 5th, Texas Roadhouse on February 7th and 10th, bought Wingstop on February 19th and 20th, bought more Chipotle, Texas Roadhouse, and Wingstop on February 21st, more Wingstop on February 24th and 26th, and received interest from cash and a juicy Starbucks dividend at the end of the month. Let's look closer at some key holdings. Celsius remains my largest holding, with 6.59 shares at a cost basis of $32.08. This position is down 19.9%. Celsius makes up 22.3% of the portfolio. This position was actually in the black for a couple of days after earnings but has since slumped back down. Still, I have managed to average down in this position, but it is inappropriately overweighted in my portfolio. Again, my top 3 positions, which now account for 56% of my portfolio instead of 59% from last month, are all in the red. I am actively working to decrease the weight of these underwater positions, but there are not many great places to put money to work in the current market. Hershey, my 5th largest position, has actually managed to crawl out of a hole and has nearly broken even. Hopefully my stable stock is starting to stabilize. Dutch Bros remains my best performing stock this month. Post-earnings, my gains in that position now sit at 166%. Unfortunately, I did not get a chance to build a larger position, and it currently occupies 3.5% of my portfolio. This month I was much more conservative with deploying cash and have $25.99 remaining, accounting for 3.4% of my portfolio. As far as the weighted average metrics for the portfolio, free cash flow per share growth, cash conversion cycle, net debt to EBITDA, and yield on cost are all better this month, continuing the trend for this portfolio in 2025. Revenue per share growth and return on invested capital are worse for this month, while gross margin remained unchanged. As we move closer to the end of the first quarter, the market's feeling a bit jittery. We've seen some large pullbacks in tech, and the overall sentiment is cautious. Well, let's break it down. We're seeing clear signs that the rapid growth we experienced over the past 5 years is cooling off. Inflation, while showing signs of moderating, is still sticky in certain areas, particularly eggs. Consumer spending, the powerhouse of our economy, is starting to show cracks. We're seeing a shift from discretionary spending to necessities, which has played out in a migration from brand-name foods to private label brands. The Fed has been walking a tightrope, trying to balance inflation control with maintaining economic growth. Interest rates have likely peaked in the near term, making borrowing more expensive for businesses and consumers alike. This impacts investment and spending. Then, there's the tariff situation. The food, beverage, and restaurant industry is particularly dependent on global trade. We've seen an increase in trade tensions and, you guessed it, tariffs. These tariffs are creating uncertainty for businesses, particularly those with complex supply chains. They're also driving up costs for consumers. We're seeing many companies struggle to adapt. That said, the thesis for the portfolio still stands. Humans have to eat. There are still opportunities in the market and innovation continues. It will be challenging going forward, but I am excited about the opportunities. Many thanks for watching. What do you think about the portfolio? Share your thoughts below. It is always great to hear from you. Please check out some more videos right now, and don't forget to put your money where your mouth is.